Let's now look at Article 8, which deals with shipping and air transport. Now, when I say shipping, what it means is that if a person has a ship or a company has an aircraft that they are operating in international traffic, how would those taxation work in respect of the income is something which is covered by Article 8. In some cases, it will cover certain other aspects as well, which we will cover as a part of this chapter. So the first question is, where is Article 8 applicable? Article 8 covers the taxation of shipping profits, profits which a company which owns and operates a ship derives, and profits from air transport. In some of the treaties, you may find that even the profits from inland waterways transport are covered. Okay. When I say waterways, that again refers to something relating to the ships. It does not contain profits from roads or railways. What is covered is the profit from inland waterways, right? Whereas in many treaties, you may actually find that this word waterways is absent. So what are some of the points relating to Article 8, which we should know before we actually start getting into the details of the relevant text? Article 8 overrides Section 172 of the IT Act, which deals with shipping business of non-resident. In simple terms, what Section 72 provides is that if there is a non-resident, right, who picks up carriage, passengers, etc. from a port in India, then the profits which are taxable in India are 7.5% of the receipts. Now, obviously, there are different conditions which are attached to this, right? But when we talk about Article 8, since that also deals with the business of profits of a shipping company, right? And the general rule is the treaty provision override the Income Tax Act, right? Therefore, Article 8 overrides Section 172, which deals with shipping business of a non-resident. The rail or the road transport are not covered by Article 8, right? In some treaties, inland waterways may be covered, but definitely rail and road transports are outside the purview of Article 8. And the third and the important point, which we may actually repeat at one or two other points, is that Article 8 is not impacted by whether or not a non-resident has a PE in India. If you recall, in case of fee for technical services, right, if the non-resident has a permanent establishment in India, generally Article 12 dealing with FTS provides that the taxation of such fee for technical services will be governed by Article 5 read with Article 7, which means even though there's a specific article for FTS, if there is a PE, the taxation moves out from FTS to PE clause. This principle is generally not applicable to profits of a shipping or air transport company. Their profits are still going to be continued to be taxed under Article 8 unless there is a specific provision in Article 8 which tells you that the taxation should work as per Article 5 or Article 7. Let us now look at Article 8.1 of the India-USA Treaty. What it reads is that profits derived by an enterprise of a contracting state. So let's say we are talking about US here. So if there is a foreign company which is a tax resident of US, right, it provides certain services to an Indian company which are in respect of operation of ships or aircraft, then the profits which it derives from the operation by that enterprise of ships or aircraft in international traffic shall be taxable only in that state. Let's try and break this into a few parts and understand the implication of each of these points. The first one is profits derived. In many treaties, this word derived is absent. So you have only profits from the operation, right? Now what that means is that when you talk about profits derived denotes a very close nexus. So the profits which an enterprise should get should be by virtue of the operation of ships or aircraft. The source of those profits should be ships or aircraft operation. If you are operating ships and aircraft and you are also offering some services which do not have any nexus to the operation of ships or aircraft, those profits will not be covered here. So profits derived by a US enterprise from the operation by that enterprise, right? Now what this means is, let's say there are two types of companies, A and B. A gets profit from the operation of ships or aircraft, right? While B owns an aircraft but it leases it maybe to A only, and A operates them to get profit from second set of aircrafts as well. In such a case, since B is not the operator, we cannot say that the profits which B gets from lease are from operation of ships or aircraft, and therefore these profits will not be covered under Article 8, right? So it's only the profits which are derived by an enterprise from the operation of ships or aircraft which are taxable under Article 8. And where should the operation be? The operation should be in international traffic. So if you are an enterprise who is flying an aircraft between two US cities, even though the passengers who are there are all Indians, it doesn't make a difference. The operation should be in international traffic, shall be taxable only in that state, which is US, right? In some of the treaties, you may find that instead of this, the criteria is where is the place of effective management of the company which is operating the ships or aircraft. And it is the place of effective management of the ship or aircraft, right, of the enterprise, where these profits are taxable, right? So if the place of effective management is not in US, but some third state, then the right to tax these profits will be with that third state and not with US. Now, one other thing is that the treaty says that the profits from the operation of ships and aircraft, which means that there is a technical possibility that a company may be running more than one businesses, in which case it is only the profits from ships and aircraft which are taxable under Article 8. Let us now look at one clause which is based on the place of effective management rule. So if you look at Article 8.1 of the India-Cyprus Treaty, it says profits derived by an enterprise registered and having the headquarters, that is effective management, in a contracting state. So if there is a company which is both registered plus having the place of effective management in Cyprus, from the operation, same interpretation, by that enterprise of ships or aircraft in international traffic shall be taxable only in that state, right? So wherever the registration and place of effective management is, that is the country which gets the right to tax these profits. Now the next question which comes up is, what is covered under ships and aircraft? Ships would cover your merchandise vessels, right? Your tramps, the feeder vessels, okay? Aircraft would cover any structure or machine which is designed to travel through the air. One case has kind of concluded that hovercrafts are not covered as a part of aircraft. right?